Hello, very good morning to all, and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be the Wednesday, the 18th of June 2025. So as usual, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so as usual, let's have a quick recap what has taken shape yesterday first before we dive into the gist of the daily dose, which is the intraday technical outlook on all the various key cross asset classes ranging from the major US dollar pair, the major stock indices, and as well as the two key commodities, WTI crude, gold XAU/USD that we cover on a daily basis. So in terms of yesterday's key events data that impact the movement of these various cross asset classes will be primarily focusing on the Israel-Iran ongoing conflict that's pretty much fluid in the Middle East region right now. So what we see over here is that yesterday we do have a kind of a U-turn from US President Trump. Yesterday, what he did over here is that he actually mentioned, stating that he's now weighing an option to actually strike Iran, and the ongoing retaliation move between these two hotbed country in the Middle East continues to actually ratchet up. That means both Iran and Israel start to trade firepower by attacking various airstrikes towards their respective country. So yesterday, Trump actually he actually did a very bold remark or stalking remark, saying that Trump posted a demand for Iran unconditional surrender and warned of a possible strike against the country's supreme leader, saying that he knows where the supreme leader is hiding and he's an easy target. So based on this kind of a reversal of remark that was initially kind of put up on Monday, where he actually mentioned that Iran is willing to actually strike, not willing to actually come back to the negotiation table to kind of rediscuss its nuclear enrichment program. But yesterday is more of a U-turn, and Trump's remarks rather pointing towards a rather hawkish rhetoric, siding more toward Israel, that stating that Iran got to unconditionally surrender, and that potentially give a signal to the market that US may get involved in this ongoing Israel-Iran conflict. All right, so with that, that created a risk-off scenario for the major US stock indices. So the major US stock indices, all four of them closed in the red yesterday. So since the start of the US session, the market actually tumbled all the way down and closed at the low for the day at the end of yesterday US session. So the SPX is down by negative 0.84%. The Nasdaq underperformed, given that it's the higher beta major stock indices consists of that highly growth oriented centric mega cap technology stocks that's have a higher weightage in the Nasdaq 100. They are down by negative 1% exactly. The Dow Jones down negative 0.7%, and the Russell 2000 almost down at the same pace as the Nasdaq 100, negative 1.04%. So what we could see over here is that we see a minor risk-off episode coming back into the market. So this minor risk-off episode coming back to the market very clearly hit on the major US stock indices. It also hit the European stock indices as well. So the European stock indices yesterday also closed deeply in the red, where the German DAX closed by negative 1.12%. So that also came in within our intraday technical outlook. We call it trend bias, which we covered yesterday as well, where we highlighted the various short-term pivotal resistance on the German DAX, the three major US stock indices, which is the Nasdaq 100, the SPX 500, and the US Wall Street 30, that's representing the Dow Jones Industrial Average. All of them traded lower below this respective key short-term pivotal resistance which we highlighted yesterday. So later I'll do an update on that when we cover the second segment of the daily dose. But what's interesting over here is that yesterday, yes, we see a risk off in the market, but this risk off in the market suddenly see a spike in the dollar strength. All right, so what we could see over here is that the US dollar over here. So since this was Tuesday, yeah, at the start of the US session, you could see my cursor over here, the dollar actually jumped, all right, it jumped and it starts to trade at the higher end of on Friday, right, before doing a bit of setback in today's Asia session. Okay, so this is a 5-day rolling performance of the dollar. So what it means that at the start of yesterday's US session, which is Singapore time, around this 21, yeah, this mark here, okay, this 2100 9 p.m. mark, it see a spike up. All right, so after that spike up in today's Asia session, if I reduce it to a 1-day rolling performance, we start to see the dollar strength starts to trend downwards as well. So I would say that yesterday's push up in the US dollar doesn't really have a strong movement to say that we are now at the start of a very significant multi-week bullish reversal in the US dollar. Why? Because if I have to look at the technical price action perspective on the US dollar index, is still trading below the it's still trading below the 20-day moving average that is acting as a resistance at around the 99 level. All right, so yesterday the dollar bounced by 0.7%. Looking at the US dollar index as the gauge for dollar strength, kind of a general consensus of dollar strength, dollar weakness. So it bounced by this 0.7%, and this bounce is seems to be the highest since May. Give me the 0.7%. Yeah, this is the highest since 8th of May. All right, but it's still trading below the 20-day moving average, and it's still trading below the 50-day moving average over here. So there isn't the means, i.e., the short and the medium term trend on the short and the medium term downtrend of the US dollar hasn't reversed yet to the upside at this point in time as we are speaking. Okay, so and also interestingly is that we start to see risk off in the major US stock indices yesterday, but this time around the risk off that is being triggered by this escalation of this Iran-Israel conflict, where US may now seems to have a higher probability of taking part in this conflict as well, doesn't really see a strong build up in the yellow metal, which is gold XAU/USD. So if you look at gold XAU/USD, they actually traded down yesterday, but what's interesting over here is that they are still holding above the rising 20-day moving average. Okay, that is acting as a very clear near-term support every time gold dip down to it since 22nd of May. So every time it hit at the 20-day moving average, there is some form of we call it buying the dip mentality coming back into the market. So this 20-day moving average is pretty much of an important level to take note of. So right now, this 20-day moving average, if you put at it, is hovering at around this 3,003. Okay, give me in fact, it's this level here. Yeah, 3,350 level. Okay, so what you see for gold over here is that yes, we start to see a spike up in gold before the Israel-Iran conflict flare up on Friday. All right, so in fact it starts to actually push up on last Wednesday, and the Israel-Iran we call it ongoing conflict was that flaring point was the sudden Israel strike on key targets in Iran. So that took shape on Friday over here. So after that, during the Asia session that kickstarted this week on Monday, gold prices has been trading much lower, so they're actually down from an intraday high to an intraday low. That means intraday high on this Monday to intraday low at this point in time as we are speaking today, which is Wednesday, they are down by negative 2.34%. So that's starting from Friday. So to me, I view it as a readjustment of a positioning. Do not forget, on top of this, we do have another precious metal as well, which is silver. So silver, they do have some form of, we call it safe haven element to it, but silver is a bit of mix. So silver also taking into account of industrial demand as well, because given the nature of silver, that could be used on various industrial application. But for silver, we start to see the reverse or the opposite of what has taken shape versus gold. All right, so if you put the chart of silver over here, Friday, okay, so this was 16th of Monday, so we're talking about Friday. So even when Israel strike Iran on Friday, gold price just traded traded sideways, muted over here. And what we could see over here is that, okay, this is Friday, right? Okay, gold price rose by 3.3% from Friday's low all the way up to the current intraday session high. 3.4%. So what we could see over here is a bit of a readjustment or a repositioning between these two related kind of precious metal, a bit of short-term underperformance in gold, and I would say that it's a positioning that's being feed on into the silver prices right now. So that could actually potentially explain why gold didn't actually manage to see a bid up yesterday, despite we start to see a risk off environment in the major US stock indices. All right, and what's interesting over here is that the ratio chart of the silver versus gold also starts to see a significant medium-term outperformance by this silver gold ratio chart. And by this outperformance of this silver gold ratio chart, that also potentially attracted quantitative speculators to actually have to rotate into the silver precious metal. So a bit of positioning adjustment, I would say that. All right, so that could potentially explain, like I mentioned, why gold did manage to see a build up yesterday, despite we see escalation in the Israel-Iran conflict. And for sure, the one that is pushing up, or the one that is primarily the focus will be the West Texas crude oil prices, because given the fact that this Iran is a very key strategic player, they being one of the, I think the third biggest producer of oil in the Middle East, and they also potentially is very close to the Straits of Hormuz, where most of the Middle East oil supply got to flow through from the Strait of Hormuz to the rest of the world, and potentially Iran could use the Strait of Hormuz as a strategic area to shut down global oil supply if Iran's strategic interest is being threatened by Israel and now coming US as well. So yesterday, West Texas crude oil rallied up by 5.3% and retested last Friday and Monday high right over here at the $75.20 dollar per barrel. So what we could see over here is a very strong bullish momentum yesterday that also came in line with our bullish bias on West Texas oil well, because the pullback that was seen on Monday managed to store right exactly at a bunch of key support level, the 200-day moving average and the former major descending resistance from 28 September 2023 high now turns into a pullback support level. All right, so later I'll touch on what are the key levels to watch again for the short-term intraday outlook for West Texas crude oil. Okay, now another data I want to highlight over here, or event I will highlight over here, is more pertaining to BOJ. So BOJ, yesterday I covered very briefly because the announcement took shape only right after our daily dose, at the end of our daily dose on yesterday's session. So BOJ chose to remain stand pat for the third consecutive time by maintaining its key short-term policy bank rate at 0.5%, and it will also slow down its reduction of bond purchases from the next fiscal year. to ensure market stability while sticking to the path of normalization that includes the possibility of more rates hikes. So it's more of a balanced approach. So right now, we know that the Bank of Japan is no longer doing quantitative easing since they start hiking rates about 1.5 years ago. So at this moment in time, for every quarter, there will be a monthly reduction of their JGB purchases, or we call it the JGB tempering program. So at this point in time, they are doing 400 billion per month for every quarter, and this will be reduced to 200 billion yen per month for every quarter starting next fiscal year. So starting FY 2026. So Japan's fiscal year starts in 1st of April. So that will kickstart on 1st April 2026. So one of the reasons why they are doing this over here is that because last month there is a significant push up in the JGB yield, especially the longer term tenure, where the 30-year JGB yield skyrocketed to 3.2%. That's a record high. All right. So we know that the Japanese has a very significant widening fiscal budget deficit. So with an increase in JGB yield, that could actually strain the government financials over here, and to actually prevent any further spike up in the JGB yield, or I would say that to actually slow the pace of the rise in JGB yield, the Bank of Japan was being kind of forced to actually reduce the bond tempering pace. So net overall, I would say that it's still a very balanced BOJ monetary policy stance. On one hand, they do not want the JGB yields to actually raise rapidly, but if you look at fundamental perspective, the JGB yield is actually moving in line with global bond yields rather than the upside on the downside, because due to higher inflationary trend, potentially due to Trump's or US White House administration global trade tariffs policy, and as well as right now we know that oil prices doesn't seems to be heading down towards the $50 mark anymore, and if things continues to escalate in the Middle East region and drag on for last for a couple of months, then that would see oil prices heating up at a higher band around the $70 to $80 per barrel. So that could also potentially see a build up in global inflation trend as well. All right, so net overall, we start to see the big sideways range in the dollar yen trading at around 145 figure level, and at the bottom we see finding support at around the 144.20 level. All right, so later I'll touch on the dollar yen. So in the short term technical outlook, so it's more likely trapped in the very sideways range for now. Okay, so now with that, one more data I want to highlight is the state of the US economy. So yesterday we do have one important US economy data, which is retail sales. Why retail sales is important? Because retail sales forms the services activity in the US, which contribute to close to 3/4 of US economic growth. So yesterday retail sales, okay, give me a minute. Okay, yeah, retail sales year on year for May, it came in way below the previous month print of 5%. All right, so even the 5% print for the month of April was revised downwards earlier for 5.2%. So if you look at the trend of the retail sales in US year on year basis, right? So it went down. So this is the lowest level that is being kind of seen since October 2024. And if you look at the 10-year trend, it seems to be now getting lackluster and pointing downwards. So it seems to us that the retail spending in the US is rather lackluster. So that also boils down to the fact that potentially if the US tariff starts to boomerang back into the US economy, that means, i.e., if a US corporation could no longer absorb the higher additional costs of trade tariffs, and if they start to pass down to the consumer goods, US certain given retail sales is weak, so that could potentially see a further drag down in retail sales, because a higher cost of consumer goods prices that will lead to lower demand and potentially retail sales dip, and that actually see a negative feedback loop in the services activity of the US. And in the second half of this year, we may start to see a slowdown in the headline GDP number for the US economy. So net overall, that doesn't gel well to the state of affairs in the US. All right. So now with that sum up the first segment of today's daily dose. So let us now touch on the second segment, which is the intraday technical outlook. All right. So let me expand my screen. Okay. So let me touch on the FX market first. Okay, over here, so let's start with the euro dollar. All right, so the euro dollar yesterday plummeted, so this came in line with the sudden push up of the dollar strength yesterday. So but it managed to actually find support around the 114.90 short-term pivotal support level that we highlighted yesterday, and given a bit of excess over here. And we also start to see the hourly RSI starts to actually dip up from a oversold region. All right, so this oversold region is quite pretty much extreme on the downside, and is the rather low oversold region, lowest before since 29th of May. All right, over here. So with this dip, and also what you could see over here is that there is a bullish divergence as well. Okay, there's a higher low over here. Okay, before the price exit from the oversold. All right, over here, whereas you see the price action starts to do same low. All right, so this is considered as a bullish divergence. So we have a bit of excess over here. So excess at this 114.75. So I use this excess 114.90 slash 114.75 to have a kind of a recovery scenario for today on the euro dollar, given the bullish divergence that's being flashed out on the hourly RSI, and the RSI hit a rather extreme oversold level before that exit from it as we are speaking right now. So 114.90 slash 114.75, the excess of the pivotal support level. First resistance level to watch for today, 115.50. So only a breakout above 115.50 may potentially see the retest of this minor range resistance that has been enforced since last Thursday, which is at 116.10. Only a sudden breakdown below 114.75 that will invalidate the recovery scenario on the euro dollar for today, to see it extending its minor corrective decline sequence to retest the rising 20-day moving average at 114.10. A breakdown below 140.10 sees the medium term pivotal medium term support level at 113.60, which is the 50-day moving average, and as well as confluencing with the minor swing low area of 2nd of June, 4th of June, and the lower limit of this minor ascending channel, means the ascending channel support that I drew from the low of 12th of May. Okay, so that's for the euro dollar. So the one that has underperformed the most will be the sterling yesterday, where it plummeted very steeply below the 20-day moving average. So ever since it break down below the 20-day moving average, which is our short-term pivotal support yesterday, it actually dipped very deep all the way down. All right, so what you could see over here is that it's now coming very close to the 50-day moving average, and this 50-day moving average also constitute with the previous congestion area over here at 133.70. And if you were to do the Fibo retracement, taking into account of the ongoing medium-term uptrend that is in place since the start of this year, within this major ascending channel as well, you do the Fibo retracement for all the way down from the from the swing low of 13th of Jan to the recent high that was on last Friday. It's constitute the ratio of 23.6% ratio. All right, over here. Now back to the 1 hour chart. So there it seems to be 133.70 is a kind of a inflection level, so far a key inflection level for the sterling dollar. So given that this very steep sell off that has taken shape yesterday has hit also an extreme oversold level on the hourly RSI, and this extreme oversold level based on a hourly basis, if I were to draw this line over here, okay, let me share with you. So this extreme oversold level at the 16.18 level, 16.8 is the deepest extreme oversold since the start of this year, which is 8th of January. So given this rather extreme oversold level on the hourly RSI, indicating a kind of a overstretch minor overstretch intraday decline or that has taken shape yesterday in the sterling dollar. So boarding the fact that it's coming very close to a key inflection level at the 50-day moving average, which is being determined by a couple of other support definition as well, the 23.6 Fibo retracement, and as well as the graphical congestion area over here in May, right, in 20th and in this 19th of May and 20th of May. So I'll be using this 133.70 as my pivotal support for today, because this will be the level that I highlighted, 134.15. So previously we say that if this 135.10, 135.30 break, this will be the alternate support level that the sterling dollar may thunder down towards. So it already hit the support level. So I do not want to be outright bearish right now, given that it's coming very close to a key inflection level. Plus the hourly RSI hit a rather extreme oversold level. The lowest, the oversold level that is the lowest so far since the start of this year. So with that, there could be at least in the very short term basis for today on the intraday, there could be a counter trend rebound taking shape or a minor recovery. So I'll be using 133.70 as my short term pivotal support level to watch out for the sterling dollar. First resistance zone at 135.10/135.30 for that potential counter trend rebound scenario to take shape in the first step. Only a breakout above 135.30, which is above, right, reintegrating back above the 20-day moving average. So that could increase the odds of a recovery for the sterling dollar to retest last Friday's swing high area at 136.40 next. However, if price actions continues to plummet downwards towards 133.70, then back a bearish breakdown with an hourly close below 133.70, pardon me, then we could see a much more pronounced extension of this minor corrective decline sequence to extend further to the downside, with the next support level coming in at 132.60. So 132.60 is the minor swing low area of 15th of May and 16th of May, and also correspond pretty much closely with the lower boundary of that medium term ascending channel that I drew from the start of this year, okay, the January swing low area, right? So that's for the sterling dollar. Next up will be the Aussie dollar over here. So the Aussie dollar managed to actually stage that sell off, right, towards our support zone at this 64.70, 64.55, which is so the rising 20-day moving average. And right now we start to see the hourly RSI inching upwards from the oversold region. So potentially right now, given that this 20-day moving average has been a support level, every time it's tested it since last Friday, it managed to bounce, and potentially right now we may start to see another mean reversion bounce up towards the upper limit of this complex sideways range configuration that is still in play since April this year, right? So I'm talking about this April sideways range configuration, right? Rather complex sideways range configuration on the Aussie dollar. So with that, we will now flip to a intraday bullish bias within this sideways range configuration, since the support has been made yesterday, and also it hit the 20-day moving average as well. So using this 64.55 as my short-term pivotal support level, flip back to a intraday bullish bias within this sideways range configuration. Resistance to watch will be the upper limit of this sideways range, which still remaining at 65.37/65.45. Only a breakdown below 64.55 that would see the extension of this corrective down move to revisit the lower limit of this sideways range configuration at this 64.30 over here. Let me put it in writing, 0.6430, which is the intersection now between the 200-day and the 50-day moving average. Below it may see a retest of the swing low of 29th of May and 30th of May at 64.07 next. All right, so that's for the Aussie dollar, flipping to a intraday bullish bias to see a retest on the upper limit of the sideways range configuration, using 64.55 as my short-term pivotal support for today. Next up, dollar yen. All right, so dollar yen yesterday we were neutral between 145.35 and 143.90, which is a confluence of the 50-day and the 20-day moving average. So we know that this this dollar yen starts to trade inside this sideways range configuration. So let me share with you guys over here. So if you could go to the 4-hour time frame, okay, let me share with you. Okay, so since ever since hitting this low here of 22nd of April, it starts to trade inside this kind of complex sideways range configuration. All right, so it seems to be a range within a range. So from the low of 22nd of May, it's more like a horizontal sideways range configuration over here. Now back to the hourly chart. Okay, so what I could see over here is that yesterday it hit the upper limit of our sideways range, all right, before staging a bearish reaction of it or negative reaction of it. All right, so in this negative reaction, the price action starts to shape a higher high. This higher high, but in the same period where price action shape a higher high, the hourly RSI has starts to do a lower high instead. Right, so this constitute a lack of upside momentum upon hitting the upper limit of our neutrality range yesterday. So now with that, that potentially could start to see a drift down back towards the lower limit, or at least the middle part of this sideways range configuration. All right, the minor sideways range configuration that has taken shape since 22nd of May low. So with that, for today, I will flip to a bearish bias within a sideways range configuration, given that there's no clear trend on the upside or downside, but it hit the upper limit of the sideways range, so give us an opportunity for it to potentially see some form of downside pressure towards the middle part of the range. So first support level to watch out for will be 14450, which was the minor swing low area that managed to find support after BOJ decision yesterday. Below 14450 exposes 14390 next. All right, so that will be the confluence of the 20 and the 50-day moving average. Only a breakdown below 14390 may see a further drift down to retest the minor sideways range support level or the lower limit at 143 figure level. Only a bullish breakout above 14535 may see a squeeze up or invalidate this bearish bias towards push up for the next intermediate resistance to come in at 14610, which is the minor swing high area of 29th of May and 15th of May. All right, so above 14610 sees a further up move towards 14715, which is the minor swing high area of 14th of May and 14th of May and 15th of May over here. All right, so i.e. using 14535 short-term pivotal resistance for today, we will flip to a intraday bearish bias given the bearish momentum that's being depicted on the hourly RSI, for it to drift down towards the middle part of the range for the dollar yen. All right, so now that sum up the intraday outlook for the major dollar pair. Let us now move our focus to the major stock indices. All right, starting with the Hang Seng. All right, the Hong Kong 33 representing the Hang Seng index over here. So the Hong Kong 33 right now today, it actually opened lower in line with the so-called weakness that is being seen in the major US stock indices, but it still managed to actually hold at the short-term pivotal support as we are speaking right now over here. So with that, we will still maintain that bullish bias, but right now I have an upside trigger level, which is this level over here, which is today's Asia session high at the starting at the opening bell of the Hong Kong stock market, which is 23,900 level. Okay, oops, let me put it over here. Okay, let me put it in writing. Okay, hopefully it's up. All right, give me a couple of seconds for it to come up. Okay, what is it? Okay, good. It's up 23,900. Okay, 23,900 will be my upside trigger level. Above 23,900, revisit the swing high earlier that formed on Monday during the US session. This Monday, 24,240. Okay, so this will be the level. All right, but however, if we start to see a plunge down below 23,690, then the bullish bias will be negated to expose the next near-term support zone at 23,600, 23,440, which is the minor ascending channel support that I drew from the low of 16th of April. Below it, trigger off a much more deeper corrective pullback to expose 23,060 and even 22,700, which is the 50-day moving average. All right, so what I do over here is that I'll still use the pivotal support because price action seems to be stalling right now at the 20-day moving average, which is 23,690, but I added an upside trigger level for the Hong Kong 33 to clear in order to increase the probability of a recovery scenario, which is 23,900. All right, so that's for the Hong Kong 33 representing the Hang Seng Index. Next up will be the Nikkei 225 over here, representing the Japan 225 representing the Nikkei 225. So the Nikkei 225 or the Japan 225, pardon me, in our platform continues to be stuck inside this sideways range. So it could be the form of a minor ascending triangle. So I'll be using this. It's now retesting that 38,850 level. So this 38,850 level will be a short-term pivotal resistance level. So I will still maintain that kind of a intraday bearish bias for a possibility of it to revert back to the lower limit of this minor ascending channel support area over here, which is at 38. Okay, let me so it should be a zone here right now. Okay, so this should be the zone. Okay, let me do a proper one. Okay, 37,820. And 38,145. Okay, 38,145, 37,820. All right, so this will be the two near-term support level to watch over here for it to do that bearish mean reversion to retest the lower limit of this minor ascending triangle range configuration. All right, however, if price action starts to do a breakout above 38,850 with an hourly close above it, then I would say that this mean reversion scenario to retest that lower limit of this minor ascending triangle formation or range configuration will be invalidated to kind of see a bullish breakout of this range configuration that was previously in place since the high of 13th of May. So that's close to about a month or so to seek out the next resistance level, at least in first step at 39,560 for today. All right, so that's for the Japan 225. All right, up next will be the Germany 30 that represents the German DAX over here. So the German DAX yesterday floated down from our pivotal resistance level that we have a bearish bias 23,675, and right now there is no sign of a bullish divergence that's being seen on the hourly RSI, and the hourly RSI continues to flash out a series of lower high, okay, over here, lower high, and hasn't hit the oversold region yet. All right, so indicating that downside momentum still remains intact. So a breakdown below 23,310 for today will expose the next near-term support level at 23,150, followed by 22,910, which is the minor swing low area of 8th of May and 6th of May, and so confluence with the 50-day moving average very closely. So still maintaining our intraday trend bearish bias for the Germany 30, still using 23,675 as my pivotal resistance level because it's still configured in this kind of what's minor sideways range configuration. Unless it can break down below 23,310, then I could tighten my short-term pivotal resistance level to the gap resistance over here, that gap down over here on Tuesday at 23,550. Only a push up above 23,675 will invalidate today's intraday trend bearish bias to see a squeeze up to revisit the 20-day moving average, which is confluencing with the next intermediate resistance zone at 23,880/24,025. Right, so that's for the Germany 30. Up next will be the major US stock indices, starting with the US Wall Street 30, which represent the Dow Jones Industrial Average. So the US Wall Street 30 also drifted downwards hitting our first support area at 42,020, 41,850, which is the minor swing low area of 22nd of May, 30th of May, and 2nd of June over here. So given that it hasn't broken down below this first short-term support zone that we highlighted, we will not want to tighten my short-term pivotal support resistance level, pardon me, to be so tight. So I will use the 20-day moving average over here, roughly this level, okay, which is at 42,400. So this will be my first resistance level to watch out for today. But the pivotal resistance zone still remains the same at around the 200-day moving average, and that minor push up before the price of the US Wall Street 30 sold off on Monday. So at 42,580/700 will remains the short-term pivotal resistance level to maintain our intraday trend bearish bias for the US Wall Street 30. Below 41,850 exposes the next near-term support coming in at 41,530, which is pretty much close to the rising 50-day moving average as well. So that's for the US Wall Street 30. Only a sudden bullish reversal and hourly close above 42,700 that would invalidate today's intraday trend bearish bias. Invalidate today's intraday trend bearish bias to see a recovery to retest the minor swing high of last Wednesday at 43,085. Next up will be the S&P 500 or the SPX 500, we call it. So price action continues to inch down much lower from our pivotal resistance that we highlighted yesterday as well. Still remains the same at 6,050. So 6,050 short-term pivotal resistance on the S&P 500, maintaining that intraday bearish bias. First support level to watch will be the 20-day moving average at 5,940. So this is something like a downside trigger level that managed to survive on the first flare up of the Iran-Israel conflict that took shape on Friday. So a breakdown below 559.40 may expose further, we call it a drift downwards towards 5,850, which correspond to the 200-day moving average as well. So still maintaining that intraday trend bearish bias stance. All right. However, only a bullish breakout and hourly close above 6,050. So that will invalidate the bearish bias to kickstart a recovery in first step, and for it to seek out the next intermediate resistance at 6,093, slightly below the all-time high area at 6,151. Lastly will be the Nasdaq 100. So the Nasdaq 100 also drift downwards as well. Over here, we have the 22,050 as my short-term pivotal resistance level. So I don't want to put it so tight at 21,900 just in case of any whipsaw again. So 22,050 short-term pivotal resistance on the Nasdaq 100. Two support level to watch. First support level to watch where it managed to survive in today's Asia session will be at 21,650. Below 21,650, expose the downside trigger level of 21,500 next, which is the 20-day moving average that managed to survive on Friday. Only a breakdown below 21,500 will give us more clarity that the Nasdaq 100 has indeed formed a minor top at 22,050, where it may start to see a series of minor corrective decline sequence, exposing the next near-term support zone at 21,180/21,030 in the first step. Only a bullish move upwards and hourly close above 22,050 will invalidate today's intraday trend bearish bias to see a squeeze up to retest the all-time high area at 22,200/22,250. All right, so that sum up the intraday technical outlook on the major stock indices. Let us now proceed with the commodities asset classes, starting with the gold XAU/USD. So for gold XAU/USD, what we could see over here is that yesterday we do have a pivotal. Okay, let me put it okay, again. Okay, this should be in green now. Okay, so yesterday we do have a pivotal support with a bit of excess over here at this 30, okay, give me a minute. Okay, 33.80 level. Okay, 380. Okay, so we have a bit of excess at this level here, 33 3400, 3380. So prices seems to be forming at this area here, okay, forming some kind of support level with this form of rising hourly RSI as well. All right, there's this rise of this hourly RSI. So with that, I will still be using this as my short-term pivotal support zone because it didn't have a clear breakdown below 33,380, which is the excess that I highlighted yesterday. So resistance level to watch, at least in the very, very short term, will be this level here. Okay, this level. Okay, let me expand. So you can see. So if you do the Fibo retracement of this ongoing minor corrective decline from the high of this Monday all the way down to yesterday's US session low, that also correspond to the golden ratio of 61.8%, pretty much closely at 3118. So this 30 is 3418, pardon me. So this 3423, 3423. Okay, so this will be my first resistance level to watch. Above 3423 may retest this Monday minus swing high at 3450 next over here. So however, if price action starts to see a push down below 3380, then we may see the extension of this minor corrective decline, retesting 3446, which is the rising 20-day moving average, and as well as the minor ascending channel support that I drew from the low of 29th of May. All right, so if price action hit below this level, I'll be also looking out signs for any sign of a bullish reversal candlestick as well, because it is also another important support level to look out for, or inflection level to look out for, at least on a hourly intraday basis for gold XAU/USD. All right, so net overall, still keeping the excess pivotal support as level to watch, 3380, maintaining that intraday bullish bias for a recovery, given what we could see the rising higher low that's being depicted on the hourly RSI. And first resistance to watch will be 3423. Above 3423 sees a retest at 3450, which is the minor swing high of this Monday. So that's for gold XAU/USD. So next up will be the West Texas oil. So West Texas oil, yesterday we have a bullish bias over here. So right now it's testing the upper limit of the 75.18, that range top that has taken shape on Friday. So there's no clear break above 75.18. I do not want to tighten my pivotal support level to be so tight, because just in case of any wild whipsaw in this sideway range. And I have a first support level to watch will be this minor swing high here. Now turns into a first pullback support. Minus swing high, there was some kind of sell-off before the price push up further, right? So this is 73.20. Unless we have an hourly close above 75.18, then I could tighten my short-term pivotal support level, which is at 70.60/69.15, the 200-day moving average, to be 73.20. So for now, pivotal support zone still remains the same. Above 75.18 sees 77 figure /77.60 next on the intraday basis. Only a sudden breakdown below 69.15 that would invalidate the bullish breakout scenario that has taken shape on last Friday, to see oil prices trendle downwards again towards the minor swing low of 12th of June and the former minor swing high of 10th of June at 67 figures /66.27 next. All right, so still maintaining that intraday bullish bias on West Texas oil. Okay, so that also sum up the intraday technical outlook on these major cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for? So today is FOMC day, the US Federal Reserve meeting outcome. So prior to that, we have one important data that could actually shape the movement of the sterling dollar, the sterling crosses, and the UK 100 will be a UK inflation rate. All right. So for UK inflation rate, they do expect the core inflation rate to come in slightly lower than the previous print of 3.8% year on year in April to dip down to 3.6%. That is consensus forecast, something to look out for. And also after that, we do see a slew of ECB officials speaking at 3:30 p.m. to 3:50 p.m. ECB Edison, ECB Dontry, and ECB Mahidu. All right, and stretching into the US session, we will have the all important. Okay, prior to that, we have the EIA weekly crude oil stockpile change, so that could influence the movement of the West Texas crude oil as well, potentially 10:30 p.m. Singapore time. Then thereafter will be the all-important FOMC interest rate decision that will be out at 2 a.m. Singapore time. So market is now expecting no change, 4.25% to 4%, but what market is focusing on will be the release of the latest dot plot. So the previous dot plot that was released 3 months ago, which is in March, indicate that the Fed will have 2 interest rate cut before 2025 ends. So market is looking at whether the Fed still maintain this potential 2 interest rate cut, which is the CME Fed Watch 2 has really priced in to come in September and December, and also whether the Fed will revise the inflationary trend trajectory and a GDP growth trajectory for 2025, 2026, as well as the longer term. All right. So something to look out for, especially the inflation trend, given the uncertainty surrounding the current situation right now. Number one, potentially higher oil prices, and as well as the erratic trade tariffs implementation by the US White House administration. Then thereafter, 2:30 p.m. Singapore time, we have the Fed chair press conference that could also influence the major cross asset classes as well. So that will be at 2:30 a.m. Singapore time. And as we head into the early Asia session tomorrow, before the start of our daily dose at 11 a.m., at 6:45 a.m. for those who have interest in the Kiwi dollar and the Kiwi crosses, we have a Q1 New Zealand GDP rate coming out at 6:45 a.m. Singapore time tomorrow. And at 9:30 a.m., we have Tier 1 Australia labor data, employment change, and unemployment rate. So for employment change, Australia data, market is expecting a low ball number. Previously added 89k jobs for the month of April. This time market only expecting, or the consensus is expecting only 25k jobs added. So that could potentially influence the movement of the Aussie dollar and the Aussie crosses when the data release at 9:30 a.m. Singapore time tomorrow. All right, so with that, that sum up today's daily dose of market insights. Do have a great day ahead, and we shall speak again tomorrow. Thank you.